So today we'll cover what LMI actually is and how it works, why banks charge it when you borrow more than 80% loan to value ratio, how LMI connects to the first home guarantee 5% deposit scheme, LMI waivers for eligible professions, and when paying LMI can actually be worth it. So let's jump in. Hello, and welcome to First Home Unlocked, the podcast for unlocking clarity and confidence for first home buyers. I'm Jack Elliott, National First Home Buyer Specialist at Alcove.
And I'm Chris Bates, ex-financial planner and mortgage broker.
Together, we are on a mission to empower you with the keys to unlock your first home. Let's jump in. Welcome back to First Home Unlocked. How's your week been, Chris?
Been good, Jack. It was my boy's 4th birthday party last weekend, which was actually a couple of weekends ago now, up to Newcastle, where I grew up in Newcastle this weekend, and family time. I should do some family photos, catch up with some mates. Yeah, things are good on the home stretch to Christmas. How are you been, man?
Yeah, for me, it's coming into December, like you said, end of the year. So it's exciting. Everything's getting wrapped up for the year at work. And yeah, in the personal life, starting that Christmas shopping. So that's always a big task coming into the end of the year, but exciting. And yeah, looking forward to kind of seeing out 2025 and then, yeah, having a rest and then coming into 2026 refreshed and ready to go. So coming back to today, we're continuing our Finance 101 series and we're unpacking all things lenders mortgage insurance, also known as LMI. Now, understanding how LMI works can genuinely help you make better decisions about your deposit, your timing, and whether it makes more sense to keep saving or to enter the market soon. So today we'll cover what LMI actually is and how it works, why banks charge it when you borrow more than 80% loan to value ratio, how LMI connects to the first home guarantee 5% deposit scheme, LMI waivers for eligible professions, and when paying LMI can actually be worth it. So let's jump in. So let's start with the basics. And if you haven't listened to last week's episode on loan to value ratio, I recommend jumping back to that one first because LMI and loan to value ratio go hand in hand. So LMI is an insurance premium that protects the lender, not you, if you can't make your home loan repayment. Now, if a homeowner can't make their repayments, the property may need to be sold to pay back the bank. But if the value of the property has gone down since you purchased and the sale price isn't high enough to clear the remaining loan, the insurance company will cover the difference for the bank. Now, the insurer may then seek to recover this shortfall from the homeowner. So as you can see, LMI protects the bank, not you. Now, LMI is typically charged when you borrow more than 80% of the property value, meaning your deposit is under 20% because the loan is seen as a higher risk and the bank wants to protect themselves. Although there is support available for first home buyers where LMI is waived, and we'll talk through these options soon. So Chris, what factors determine how much LMI someone has to pay?
It's a good question, Jack. A lot of people misunderstand LMI and, they do everything they can to avoid it, just think it's a cost they don't want to pay. They sort of understand that they're never going to see that money again, which is pretty much true, right? But by actually trying to avoid it at all costs, sometimes they delay their decision and there's an opportunity cost that they haven't factored in. And how LMI works really is something that you need to try to understand. It's based on sort of the LVR or the amount of deposit for the bank. The higher the insurance is, it also depends on who actually provides the LMI. There's different costs for different providers. It also depends on how big your loan is, whether it's an investment or a home, and also the bank you choose because they have different providers for it, etc. So there always is, a bit more to it than just one flat fee. And there's ways you can sort of think about it and go, well, if I get to this certain price point or this deposit, then that'll massively reduce my LMI. And I can easily get there if I sell something or I rattle the tin or I ask for a bit of help from family, etc. So yeah, it's obviously the size of the loan and the percentage of the loan, really the most two biggest factors.
Yeah, and like you said, Chris, a big thing is there's no single LMI rate across the industry. So like you said, two banks can charge very different premiums for the exact same loan amount because each lender has their own pricing model and their own agreements with their LMI providers. So for example, for a purchase price of $800,000 in New South Wales with a 10% deposit, the LMI premium can vary from around $14,000 to $18,000 at major banks currently. Now, most lenders will add the LMI premium onto your loan. So that means you don't pay it up front, you finance it over the life of the loan, and you're paying interest on it along the way. Because it increases your total loan amount, you need to be able to service the loan plus the LMI added on top. So your borrowing power is reduced compared to someone who doesn't doesn't need to pay LMI. And in many cases, loans that include LMI also attract higher interest rates because the bank is taking on more risk. So let's talk about now how LMI relates to today's first home buyer landscape. Right now, there are four main pathways that help first home buyers avoid or reduce LMI. So the first is the first home guaranteed 5% deposit scheme. Now, we've talked about this a lot on the podcast, and this is where you're able to buy with a minimum 5% deposit. You pay no lender's mortgage insurance because the government guarantees up to 15% of the property value. So the bank treats you as if you had a 20% deposit. Now, this is by far the most common LMI relief option I'm seeing my first home buyer clients take advantage of. So last financial year, 1 in 3 first home buyers used the 5% deposit scheme, meaning 2 out of 3 buyers still borrowed outside of the scheme. And look, I can see that the changes from October this year, with income caps being removed and the higher price caps being applied, we are probably likely to see even more first home buyers using the scheme in this financial year. But if you don't qualify or you can't find a property that suits your asset quality and lifestyle goals within the scheme's price caps, there are other options available to you. Now let's talk about the second pathway, LMI waivers for eligible professions. Some lenders offer LMI waivers for certain professions they see as lower risk. Things like medicine, law, accounting, and some frontline or allied health roles. Because these careers tend to have a stable income and strong long-term job security, lenders are comfortable letting eligible buyers borrow up to a certain loan-to-value ratio without charging LMI. So each lender has its own eligibility rules for LMI waivers, and they can differ quite a bit. Most lenders that offer these waivers will do so up to a 90% loan-to-value ratio, meaning you need at least a 10% deposit. But the key differences come down to who qualifies. Some lenders only accept specific professions within each industry, and others require certain job titles, registrations, or memberships before they'll even offer the waiver. And even when the waiver applies, interest rates aren't always the same. Some lenders again offer competitive pricing, while others charge higher rates to offset that additional risk. So it's definitely something to compare. So if you're in one of these fields, an LMI waiver can be a really powerful option for you. It can help you get into the market sooner without taking on the cost of LMI. Now, I have used LMI waivers with clients in industries like accounting, physiotherapy, and podiatry, and these can work really well. But there are times where a waiver looks good on paper, but it's not actually the best pathway. For example, in some industries like financial planning, LMI waivers might only be offered by 1 or 2 smaller lenders. Now, these lenders can have much longer turnaround times, sometimes up to 3 weeks before an application is even picked up, which isn't ideal if you need to act quickly on a property. And then in some cases, they often come with higher interest rates, so the overall cost needs to be weighed up as part of your plan. So the waiver itself is great, but the bigger picture, policy, turnaround times, and interest rates all need to be considered to work out if it's truly the right fit for you. Now, Chris, have you had clients use LMI waivers before, and what's been your experience with them?
Oh, absolutely. And they've got, more professions over the years. Like you said, allied health is sort of one of those. And even when you're working in the banking sector, often if you worked at a bank, they would offer it to staff, but then other banks are offering it to staff of other banks to sort of try to bank them as a customer, and hopefully they'll join their bank one day as an employee. But yeah, absolutely. I think there was always a time when 85% no LMI loans were out as well for potentially a big, broad, any industry. But what you used to find when you did the calculation of the LMI saving versus the higher interest rate, it wasn't that big of a saving. And often sometimes clients would still pay LMI, even though they could access an LMI waiver because the rate was actually cheaper. And that can really catch you out. Often in those situations, depends on how long extra you're going to pay that rate for. So if you potentially could refinance that property, in 6-12 months time, then it's maybe not a big deal. But when we have seen a more and more banks start to offer no LMI, even in recent times up to 90%. But good brokers should be across all the different LMI waivers that potentially you can get access to, or, potentially other lenders that are offering it to a broader range of profession. LMI, if you can get it, it can be a huge sort of benefit. Even if you did have a 20% deposit, you potentially could just borrow at 90%, meaning that you could keep another 10% in an offset account. Give yourself a big buffer. You might put that into a renovation. You might just leave it as a buffer. And, and if you're in the medical field, like a doctor, often they do 95%, which allows you to not only leverage into a home further, you can buy investment properties, etc. So if you are in a profession that has an LMI waiver, it's a huge advantage versus other professions around lending, and not only being able to borrow with buffers, but also leverage your money further. And that's why a lot of doctors use it extensively.
Yeah, and like you said there, Chris, as well, there's a lot to talk through. There's a lot of different options that you can compare. So that's where a good broker will sit down with you and compare all these different options. What does it look like? Yes, getting into your loan, but then also how can you use your deposit strategically with these LMI waivers to have buffers and set yourself up from the very start, especially as your first home. We always talk about how important buffers are, setting yourself up from the very beginning. So look, you did touch on it, but I want to go into it a bit deeper. There is a third pathway that we are starting to see, which is new bank policies that waive LMI for all buyers, regardless of their profession. So one lender has recently introduced a 90% loan to value ratio loans with no LMI, which applies to both owner occupied and investment loans. So essentially, the lender lets you borrow with a 10% deposit and still avoid LMI, even if you don't qualify for the first home guarantee or a professional based waiver. There are also other small non-banks that allow up to 85% or 95% loan to value ratio loans with no LMI, but your broker can help you weigh up these options as part of your plan. Chris, why do you think banks are starting to offer options like these?
Look, I think it's just the natural competition in the market and it being so fierce at the moment that I guess looking to try to get a bit of a niche in the marketplace and offering the reason why they're going to work with that bank is they're offering a benefit that others aren't. And yeah, I guess that's just the strength of the competition in our marketplace. The banks are willing to offer, which is a higher risk loan. You know, there's risks in terms of obviously capital requirements they need to hold and it's more expensive for them on their balance sheet. But they're just trying to get market share, and that's the reason they're offering this. And that's why it's not one of the main banks. It's obviously a subset brand of it. And, you know, a lot of people wouldn't know about it unless they were working with a broker. It's not massively advertised.
Yeah, and do you think, Chris, with these smaller non-banks starting to offer these policies, do you feel like we'll see major banks starting to offer these products as well?
Well, I think this 5% deposit scheme for first home buyers is pretty crazy. It's when we start seeing 90% or 95% no-LMI for investors and with interest only terms. I think that's going to be a really big, relax to lending, but I don't think that's going to happen anytime soon. But, I think that obviously we're seeing a lot of change with first home buyers in particular, which is usually makes sense, right? They think, oh, it's a high LVR loan. It's going to have a lot of a big arrears rate and they're very risky lending. The stats and the evidence don't prove that. The arrears rate for first home buyers with high LVR loans is just the same as every other loan, if not potentially better, because the first home buyers usually doing everything they can to stay ahead of their mortgage, usually getting earnings, wage increases and really wants to, get on top of their mortgage. And so they're seen as higher risk lending, but their arrears rate evidence doesn't suggest that.
And it's in particular as well with these no LMI policies that we see at different lenders. And from my experience, they often require more documentation and apply stricter living expense assessments, which can reduce your borrowing capacity. So I recently had a client where this played out. With this lender, their borrowing capacity came out much lower because of the higher living expenses applied. And when we compared it to different lenders, even with LMI added to the loan, their borrowing power was actually higher and they were able to achieve their ideal purchase price. Now, the bank we actually ended up going with also had a lower rate in this case. So even with the LMI added. So while the no LMI policy does sound great, again, it really does come back to your personal situation and your goals and comparing all the different options that you have. Now, moving on, the fourth and final pathway to avoid LMI is using a family guarantor loan. Now, this is another option that can help first home buyers get into the market sooner without needing a full 20% deposit. Now, here's how it works in simple terms. A family member, usually a parent, offers part of the equity in their property as additional security for your loan. It doesn't mean they're giving you cash or becoming a co-borrower. What it means is they're simply using a portion of their home's value to boost what the banks see as your deposit. Now, when you add their property as security, your loan looks much safer from a bank's perspective. Now, it's also important to understand the responsibility involved for the guarantor. If you were unable to meet your repayments and your home needed to be sold, the guarantor is responsible for the guaranteed portion. That's why banks assess their financial position as part of the application as well. Most lenders also allow the guarantee to be released later on. Once your property grows in value or you've paid down the loan enough, many people only need the guarantee for a few years. Now, Chris, when you're working with clients, how do you help them weighing up using a family guarantor versus buying on their own and just paying some LMI?
Look, I think that's an episode all in itself, and I think we should delve deep on it. But if you've got a a family member that can offer you a family guarantor, you got to be extremely careful using it. But if it does make sense for you, which often is the case, you really got to make sure it makes sense to the person providing the guarantor. Understanding their plans. Are they going to sell the property? Are you potentially the type of property you're buying? Is it high risk or is it low risk? How fast are you going to be able to get rid of the guarantor? Is it going to be out of brothers and sisters going to be able to use it as well? It's quite a complex and high risk lending, I would say, because not only are you risking your money, you're actually risking your parents' property, and it depends on their situation and how tight money is for them as well. And so, but for the clients that have used it over the years, it's a huge advantage because it allows you to enter the market today with basically no deposit and not even potentially pay stamp duty now with your cash. You can keep all that money in a buffer. And particularly if a property is ever going to be used as an investment property down the line, it makes a huge advantage for you to potentially keep that property and then buy a home down the line. And so, yeah, it's a very good option. However, we go in there with, it's usually a no first, and then the client, and after speaking to the parents, we get convinced that it's actually a good move for both parties.
Yeah. And like you said, Chris, there's a lot to delve into. So we will cover the family guarantor loans and we'll be doing a full deep dive in a later episode. All right, so now we've covered what LMI is and the pathways to avoid it. So let's talk about something really important because not everyone will qualify for those options. There are plenty of situations that we've seen over the years where paying LMI is actually worth it. So Chris, when do you think paying LMI makes sense for clients?
If you're in a fast moving market, often LMI, if we kind of put some rough numbers on it, if you're borrowing sort of 85 to 90%, so you're almost at the 80%, then the LMI isn't usually that bad. It's usually like 1 to 2% of the purchase price, or, and that's an easy way to think about it. But once you start borrowing more than 90% to 95%, that really can ramp up to sort of 3-4%, particularly if you've got a larger loan as well. And so that's when LMI is like, oh, I really don't want to be paying this. Often investors, it makes a lot of sense because it's tax deductible over 5 years. It's kind of like a borrowing cost. But if you're not eligible for the 5% deposit scheme, you can't get any other 90% LMI waivers, and this is really your only way to sort of enter the market, then you've got to really sort of just see it as a cost to purchase. It doesn't take much for the market to run. We're talking like 1 or 2%, and the market could move that in the space of months. And you could go, oh, hang on a sec, we should have paid that LMI. I've absolutely seen clients over the years who have tried to avoid paying LMI and have ended up paying a lot more just in opportunity cost.
Yeah, so a big advantage of what we're saying is you can get into the market sooner. And when we say buying sooner, we still mean buying a high quality asset that suits your lifestyle and your goals and is an ideal property for you that you can hold for at least 5 to 10 years. Now, if you are buying a property with strong long-term fundamentals, good location, good land value, and strong demand, that capital growth over time can far outweigh the upfront cost of LMI. That's why we talk about asset quality so much on this podcast. It's such an important factor when you are buying your first home, especially. So, Chris, like we just talked about, getting into the market sooner is a really common goal for first home buyers. How do you help people weighing up buying now versus waiting to save a bigger deposit to avoid lender's mortgage insurance?
Building a deposit to avoid lender's mortgage insurance often is really hard. Unless you're really close to that 80% and you're talking weeks, not months, you've got to be really careful of waiting. And sometimes the benefit of paying LMIs actually gives you a buffer, because I have seen clients who get so close to that 80%, they save really hard, or they restrict their purchase price to avoid LMI and they potentially don't buy the right property, or they ignore other properties because it's just, they put a mental cap on. So they go, I'll buy it 800, but they could have spent 830 and got a much better property, but they didn't have that, extra $6,000. But I think that one of the benefits is you can have a buffer. So you borrow a little bit more, you pay a little bit more lender's mortgage insurance, but then you still have some money in your bank account on settlement date. I think that's often the biggest risk with property, is running out of cash and, the stress and the peace of mind. And I really try to educate clients on that. And I've had clients over the years that, have come back, a year or two later and go, look, that was so helpful because that extra $50,000 meant that when we had the baby, we could afford the mortgage, or, I got retrenched at work and it really gave us a buffer. And I think you never want to underestimate the benefit of just having that sleep at night factor as a buffer and an offset account. And sometimes clients, you really push for that 20% deposit to avoid LMI, just don't have that sleep at night factor.
Yeah, and I think that buffer is so important. And also weighing into the factors of, yes, if you do use less of a deposit and you are taking on lender's mortgage insurance as a cost, you've got to factor in also them higher rates. But that also helps you then get into the market sooner with more of that buffer. So your broker can sit down with you and explain all the different options and what that looks like so you can make that informed decision as well. So now we've talked about why LMI can make sense in certain situations. It's also important to understand how LMI is actually priced because it isn't one flat fee. So LMI is tiered. The lower your deposit, the higher the LVR and the higher the LMI premium becomes. Now, to give you a sense of the structure, let's use the same 800,000 purchase price that we have been. So for a 20% deposit, which is 160,000, you pay no lender's mortgage insurance. A 15% deposit, so 120,000, you pay approximately $7,000 to $9,000 in LMI. 12% deposit, which is 96,000, you pay approximately $9,000 to $12,000 in LMI. 10% deposit, which is $80,000, you pay approximately $14,000 to $18,000 in LMI. And 8% deposit, so $64,000, you pay approximately $22,000 to $27,000 in LMI. So as you can see, LMI varies across lenders, so the actual amount would depend on which lender you actually choose. So Chris, what deposit goal do you think people should aim for if they can't use one of these LMI waivers and they do have to purchase with LMI? What's the sweet spot?
To be honest, it's run at 88%, sometimes 86, but just if you don't get to 88, sometimes it's 90 is okay. It's just when you start getting like a 92, 93, 94%, the LMI starts to run. But it really depends the market you're buying in and how fast it's moving. I reckon back in the day, I was really trying to get clients to that sort of 90 to 88%. But, it has definitely been times where maybe they should have just waited, got in now versus 2 or 3 months later. Just really depends on the cycle, where you are, where you're buying. But a magic number is probably around that 12% deposit. Plus, often you have to pay stamp duty, which is maybe up to 5%. So around a 17% deposit. But, when we're talking about first home buyers, obviously this 5% deposit scheme and no stamp duty in different states really does change the game because it used to be 17%, let's call it. Now it's say 5 to, maybe up to 10%. So it's a big change.
Yeah, and as you can probably tell by this episode, there's a lot to consider. When LMI comes to the conversation, there's a lot of ways to avoid it. There's also a lot of ways where it could be an advantage to use it as well. So what we recommend is booking in, having a chat with us if you're thinking about buying your first home, and we can definitely weigh up all the different options, everything that's available for you as a first home buyer. So to recap today's episode, LMI protects the lender, not the borrower. It applies when your deposit is under 20%. The cost varies based on your LVR, your loan size, and the lender. And there are a few pathways which we've talked about that help first home buyers avoid LMI, like the 5% deposit scheme, profession-based waivers, and new no-LMI policies and family guarantor loans. And even if you do pay LMI, it can still be a strategic tool, especially if it helps you enter the market sooner and buy a quality asset. So if you'd like to get your home buying journey started with us, you can book a get to know you chat at firsthomeunlocked.com.au/book. Thank you so much for listening, and thanks, Chris. We'll see you all next week.
See you next week.
Thank you so much for listening. We'd really appreciate if you could do us a huge favor. Share this episode with any first home buyers that you know so we can help more people like you feel clear, calm and confident when purchasing their first property. You can join our Facebook group, First Home Unlocked, to continue the conversation with other first home buyers. Or if you're ready to unlock your first home, you can book a get to know you chat by using the link in the show notes or by going to firsthomeunlocked.com.au. Before we go, just a reminder that everything we share on this podcast is general in nature and not tailored to your personal situation. We always recommend seeking advice from a qualified and experienced professional when making financial decisions.